Hey guys, welcome back to the channel. Today we're breaking down three major companies currently sitting near the 52-week lows and exploring whether their present opportunity is for long-term investors. But as always, this is not financial advice. Your capital is at risk and markets rise and fall, and you should always do your own research on the stocks that I do mention. Let's get into it. So the first one, as you can see, is McDonald's. It is one of the largest and most recognizable fast food chains in the world, operating across the US, international, company-owned markets, and international licensed markets too. McDonald's runs franchises restaurants globally, 7 billion of customers annually. Its business model blends company-owned stores with massive franchise network. And McDonald's generates its revenue through multiple ways: franchise fees and royalties, rent from franchisees, and sales from company-operated restaurants. This mix gives McDonald's a stable, recurring cash flow profile. And as you can see, it is priced at $268. It's down by nearly 11.91% year to date. It has a dividend yield of 2.73% and a market cap of $190 billion. Now, it was founded and IPO'd, and the IPO came out in 1965, and McDonald's has grown into a global consumer service giant, and it's led by CEO Christopher Kemsowski. Now, the company continues to expand internationally while modernizing stores and digital ordering. In my view, that the global brand has an unmatched scale, so no other brand is matching McDonald's at the minute. It's a strong franchise model with high margins and predictable cash flow, and a consistent dividend growth, and especially at the 2.73%, I believe it's also grown its dividend from nearly almost 30 to 40 plus years. Now, of course, it's doing really well with introducing technology, so the digital ordering is doing really well, delivery and loyalty programs, which is, in my view, bringing long-term growth. Now, historically, it has been resilient during recessions, which is always a good point, especially when you want a stock that can try and weather everything that could possibly happen in the market. Now, of course, there is a few problems with McDonald's, but also with any stock. You got the slower US consumer spending that could impact sales, high food and labor costs pressuring margins, currency fluctuations affect international revenue, and competitions from fast casual and delivery only brands. So that is McDonald's. Now, this is the second one, and it's Main Street Capital, the one that I always bang on about every single video in my portfolio update, because this is one of the best BDCs that I think is out there right now. So Main Street Capital, as just mentioned, is a business development company, or known as a BDC. So it specializes in lending and equity investments in lower middle market businesses. It provides long-term debt and equity capital to private companies, supporting buyouts, recapitalizations, growth financing, and acquisitions. Main Street Capital earns its money through interest income from the loans, the equity gains from portfolio companies, but also fees associated with financial deals. Its structure requires it to distribute most of its income to shareholders, which is why the dividend yield is also so high. So as you can see here, it's at $53 a share. It's down nearly 12.59% year to date. And as you can see, dividend yield is actually 7.66%. That's listed on Trading 212 and Trading View and all that. But there's actually more of a dividend yield because it gives supplement dividends. So the dividend yield actually comes to about 8 to 9%, which is quite good indeed. So it is also led by Dwayne Lewis Hicks, and he's built a diversified portfolio across multiple industries, which is known for its stable monthly dividends and disciplined underwriting. I apologise, Jane, I've probably ruined your name, but it is what it is. I cannot always pronounce the best of the best. But the reason why I love this is because it's one of the best monthly dividend stocks out there. It's rare, it's appealing for income investors. It's also got a strong track record of conservative lending and lower middle market focus, which means less competition. And historically, it's resilient credit performance as well. But of course, there is a few points to it. Now, of course, it's sensitive to interest rate changes. So if the interest rate goes higher, Main Street Capital normally sells off, because what's the point putting money in a, let's say for example, it's at 7.66% stock when the interest rate is at 5-6%. It's more safe to put your money in interest rate in a savings account than it is into a stock. But let's say, for example, the interest rate is at 2%, then it's still at 7.66% Main Street Capital. You know what's going to happen. A lot of people are going to start putting their money into Main Street Capital. So, of course, economic downturns can also increase the loan defaults, and BDCs can also be volatile during credit stress. But Main Street Capital has done very well in all of those areas. So, in my terms, I have no worry in Main Street Capital. And the next one, and the last, of course, on this video is Netflix. Now, this stock has been beaten up massively over the last few months. Now, it is one of the largest world's streaming entertainment platforms. It provides subscription streaming services for movies, TV shows, documentaries, and original content. And also on their website, it also says it still operates a legacy DVD by mail segment. Now, of course, in the UK, we don't have that, or I can't see anywhere that we have that. But it might be somewhere in the world that Netflix still does the DVDs by mail. I remember when that happened, when we used to always rent DVDs and they used to come through the post, and you used to have a few days to watch them, and then you always have to send them back or go to the local store. Now, we don't get that no more. That's probably why Blockbuster and stuff like that all went bust. But Netflix generates revenue through a few things. It generates its revenue through the monthly subscription fees that people buy when they go onto the website or their account, and they have to buy the subscription so they can watch the content. New ad-supported tiers, and now there's some subscriptions where you can get ad-free, and of course, content licensing and distribution. Its model is built on recurring revenue and global scale. Now, of course, the company IPO'd in 2003, and it's grown into a global tech entertainment powerhouse with over 200 million streaming subscribers at this current rate. Now, of course, like I say, it operates through domestic streaming, international streaming as well. And with that, I think the massive global subscriber base actually helps with Netflix bullish point. But when I say it's been beaten up, I am not joking. As you can see, it's down to 21%. Now, of course, a few things happened, like I think it's the Warner Bros. Deal that kind of happened and fell through, even though that's quite good because they still received money from it. And a few other bits and bobs that people are worried about, so like the competition from Amazon, Apple, Disney. So there is a risk to that. And getting onto the risk as well, there's like high content product costs as well that people are worried about. And they're worried that, they're getting to the point now where the subscriber growth is going to start slowing down. So we're not going to see, like you say, 10 years of the 600% growth of the stock. But I still think this is a good stock to have. It's a good stock to add to your portfolio. And I think they all are. I think these three major companies currently trading in the 52-week lows each have a different risk profile, different business model, different reasons for its recent price weakness. But of course, this is not financial advice, so please remember, do your own research before investing. But if you did enjoy the video, leave a like, hit the subscribe button, and I'll see you on the next one. Goodbye.